We're now halfway through the year, and overall our property markets around the country are very, very stable. Of course, there's some differentials between the capital cities, but generally the market is performing very well. Our property markets have been driven by a number of factors, namely record low interest rates, population growth, generally through both interstate and international migration to our education sectors, and of course there's a greater level of confidence this year than what there was last year. It's becoming increasingly expensive for people to enter the market in Melbourne and Sydney, where median house price in many cases within 5 to 10 kilometres of the CBD of those cities is in excess of now $1 million. So what that is doing, it's driving growth into those middle ring. It's the throw the rock in the pond principle, where that ripple effect, it's driving price growth in those middle ring suburbs. The other trend that's emerging, and this is right around the capital cities of Australia, is a trend towards lifestyle. It used to be about schools and transport. It's now more about lifestyle. It's about walking distance to the cafes, the coffees, the quirky bookshops, the walking distance to public transport and railway stations. Lifestyle villages are the thing that's really driving property growth. As a property advisor, when I'm taking my clients out, I don't only just show them a property, I actually walk them around the corner and show them the village. The village and the lifestyle is really what's important and is what is driving buyer behaviour in the current market. One trend that is emerging is that people are prepared now to live in smaller spaces. The 1-bedroom, the 2-bedroom apartment or unit, which is in a good location, close to the amenity, close to the CBD, people are living in those spaces because the housing in the inner city areas has simply become unaffordable. In many respects, the village has become the extension of the living room in these small spaces. We see every Saturday morning, we walk down to those villages and we'll see queues of people lining up to get into the cafes. They're having their scrambled eggs, they're having their breakfast with their families, they're reading the newspapers. The cafe has become an extension of the living room of those smaller spaces. That's a key differentiator, it's a key change in our markets over the last few years. In both Melbourne and Sydney, clearance rates all of this year in both cities have been over 70%. That's a reasonably good, solid market. Now, with clearance rates at this level, capital growth is inevitable. A balanced market is 60 to 65%, so when we're seeing clearance rates in the range of 70 to 75%, that is correlating to a capital growth in the range of 7 to 10%. If clearance rates start to get up over 80% like we saw in the last boom, we're seeing capital growth then going from 15 to 20%. That's unlikely in the current market, but what we're seeing now is a market that is growing. They're quite often at the inner city auctions, 3 to 4 bidders. What that means is on a sample of say 600 auctions every weekend, that with 3 or 4 bidders, there is only one successful bidder. The other 2 to 3 bidders who went home with nothing are then stomping up the following weekend and adding to that demand that is currently present in the market. While stock levels in Melbourne are higher this year than last year, there remains a shortage of good quality, both investment flats and apartments for sale, and a shortage of good quality family homes. The stock shortages are not just limited to Melbourne, they're affecting most of the capital cities, including Brisbane, Sydney and Adelaide. I believe that the next 6 months is going to continue to be strong, which will follow on from our previous 6 months. And that's simply because over the last 3 to 4 months we have had very little quality, both investment quality stock and quality family homes come onto our markets. So when they are presented as listings over the ensuing period into spring, when they do present onto the market, I believe they will be met by very strong buyer demand, which is going to underpin the performance, in my view, over the next 6 months. So unless there's a change in economic factors such as a rise of interest rates or a rise in unemployment, I think this market's going to continue to steam ahead. And potentially the one derailer for our markets is affordability, as it simply becomes too expensive for most Australians to enter our property markets in Melbourne and Sydney. Thanks for listening to my updates. For all the latest property news, please follow us on Twitter, subscribe to us on YouTube, like us on Facebook. And remember, when investing in property, seek independent advice.